Hey everyone, Michael here. I hope you're well. So in this video, we're going to have a look at how to research meta platforms on the Simply Wall Street Company report. Now in this video, I'm going to go through the whole report and share with you the insights that I'm gaining as I read it. And at the very end, I'll share what my next steps would be if I wanted to research the stock further. Now, if you don't want to watch the whole video and see how I go through the report, that's totally fine. I'll share the insights that I've gained from it in just a second. But if you do want to learn how to interpret the different areas of the company report, it could be beneficial watching through to the end to see how I go through that process. Now, as for the insights and a summary of the insights that I've gained from reading the report, it was quite interesting, right? So Meta Platforms, now previously called Facebook, is the company that owns the likes of Instagram, Messenger, the Facebook platform, WhatsApp, and the Oculus headset business. And if you're not already familiar with it, it's been quite well spoken about in the news, but it's been under a lot of scrutiny for the last couple of years, and it doesn't seem like that scrutiny will stop anytime soon. So there's been news about lawsuits and whistleblower news coming out, and that is putting a lot of pressure on the company. So it's trying to make this transition to the metaverse business that it wants to be known as, but it's going to have to address a lot of the concerns in its existing business. And in the most recent earnings call late last year, the company did state that it was going to spend about $5 billion over 2021 on safety and security, and that's certainly a good faith effort. Like, the company is trying to address the concerns that are in the business, but there's no denying that while it is trying to address them, it's going to still be challenging regardless of how much money it throws at the issue. It's going to be challenging for the stock. Because it's trying to transition its business and also address the concerns in its core business. So with that, the company has actually typically traded, or the next insight, the company has typically traded at like a relatively cheap valuation considering how much earnings growth it actually was experiencing. So over the years of like 2019 and 2020, the stock typically traded like a PE multiple of the 20s to 30s, even though it was experiencing earnings growth of like 20 to 30 to 35% per year, which is really high earnings growth and quite a cheap multiple considering how much earnings growth it was having. And the reason why that might be is typically because there was a lot of concern from the investment community. There's a lot of concern and like sentiment around, there's a lot of legal issues and these antitrust concerns, so investors weren't willing to pay a higher premium for the stock, right? Because there was this risk of these antitrust lawsuits coming out that could really impact the business. So investors didn't want to pay a premium even though the underlying business was performing really well. There was those future looking concerns of something might be on the horizon that could really impact this stock. So with that being said, it's like the situation right now is that the sentiment does look a bit more subdued, and that's because it's trying to make this transition to the metaverse company. So as it stands today right now, and you can see that on the snowflake here, the company is potentially undervalued. It has an incredible track record and an incredible balance sheet. So its future prospects seem pretty good, but they're not as outstanding as they were before. And the reason being is expenses, or analysts seem to believe that expenses may rise as the company tries to make this transition into the metaverse business that it wants to be known as. So its current business is a very high margin business, right? Like, it's got 80 something percent gross margins. And so it's a very profitable business as it currently stands, but it's going to have to spend a lot of money to fund this transition into the metaverse company that it wants to be. So the reason for the subdued earnings growth now of like 12% that we can see there is because we believe that analysts expect expenses to rise. And so that's why it's not going to be a cheap transition. And so the next insight is that Facebook doesn't actually pay a dividend, but it does have a buyback program, and it previously bought around $23 billion worth of stock, and just in October it announced during its earnings result, it announced it's authorized another $50 billion buyback program. And so with those combined of about $73 billion, it's expected to buy about 7.8% of the stock back. And now as a shareholder, that means obviously it's a way of returning capital to shareholders, because if you're an existing shareholder, your slice of the pie increases as Facebook decreases the amount of slices in that pie by buying stock back. So it's different to a dividend, right? A dividend would just be a cash payment, but in this sense they're doing buybacks, and that's one way they're returning capital to shareholders. The next insight was that the company does have an experienced management team, so they've got an average tenure of like 6.7 years, I believe, and however the board doesn't seem to be as experienced, right? So there's quite a few new fresh faces on the board, and they've got an average tenure of about 2 or so years. So not as experienced as the management team, but a bit more fresh-faced board team. And in regards to alignment, the management team is quite aligned with investors. They have many millions of dollars invested in the stock in their own personal name, and the board doesn't seem to be as much so. So they've got investments in the stock of a few $1,000,000, but considering the size of the company, it doesn't seem to be as aligned as the management team. So one thing to keep in mind there. And lastly, there has been a lot of insider selling over the past 12 months, but as we look into it, who actually was conducting the insider selling, it was the Chan and Zuckerberg Foundation, and that's basically their charity. And so the reason for the selling is, obviously I haven't looked into it, but it's assumed that it's basically to help fund their charitable donations because it's from the foundation itself, which owns a lot of stock. So that's the insights we've gained from looking at the report and reading through the company and the recent news. So now if you want to watch how I go through the full report in depth, we'll go through that now. So the first thing I start with is the very top of the company report, which is the Snowflake and the risks and rewards. So having a look at the risks, having a look at the Snowflake here, we can see that the company does have an impeccable balance sheet, an impeccable track record, pretty good future prospects because it passes like 3 of the 6 metrics that Simply Wall Street checks. Pretty good, if potentially pretty good value because it passes 3 of the 6 metrics that Simply Wall Street checks, and it's not a good dividend stock at all because it doesn't pay a dividend. Now, as I mentioned, it's got a buyback program, so it chooses to return capital to shareholders in that way rather than paying out a cash dividend. Now, in regards to the risk and rewards, there's more rewards than risk, but there's worth going through now. So the company is reportedly trading at about a 31% discount to Simply Wall Street's estimate of fair value. Now, that's interesting. We'll have a look at Simply Wall Street's way of calculating its fair value in just a second. So straight away, that's a good sign that, okay, this could be good value at the moment. Next, the company's earnings are forecast to grow by about 12%, just under 12% per year. Now, that's not huge earnings growth, but it's still pretty solid. Like as I mentioned previously, this company has had very high earnings growth, but it seems a bit more subdued now. And like I mentioned, that could be due to the expectations of expenses rising because of the funding the transition to the metaverse company that it wants to be known as. And the last reward is that earnings grew by 59% over the past year. So it had a really impressive past 12 months, and that's probably due to the fact that like a lot of business has gone online, and a lot of businesses, like smaller businesses especially, have elected to spend more money on digital advertising because that's where all the attention was. And so Facebook is naturally a benefit, or Meta Platforms is naturally a beneficiary of that. Now, the only risk that we've got indicated to us here is that there's been significant insider selling over the past 3 months. And as I mentioned, that was typically mostly from the foundation that they have, the Chan Zuckerberg Foundation. But there has been some other sales from particular insiders, and we'll go and look into them later in the report. So to get some more detail. Now, the next section I look at is just the potential competitors that Meta Platforms has. And as we can see here, the potential competitors are Alphabet, Snap, Match Group, and Twitter. And so knowing that Meta Platforms is primarily a social media company, it would be like Twitter and Snapchat is what you would look at as main competitors, but it's basically a digital advertising business, right? So that's why there's Google in there as well. And so to look at this, to check out this section, is important because it gives you an idea of like if you're looking at the best opportunity. So if I look at Meta Platforms here, I see like what I saw from the Snowflake, and I'm like, okay, well, just having a quick overview, I want to see if there's any other Snowflakes from the potential competitors that are more interesting than this one. So from Alphabet, like I covered the video just the other day, we can see it's got a very similar Snowflake, right? Like virtually identical except for one score on the health that it doesn't pass. So if I wanted to check out Google, like I did in that other video, I would see if it's potentially a better opportunity. Now, Snapchat has a very different Snowflake, right? So it seems to have incredible future prospects. Like it looks like it passes 6 out of 6, whereas it doesn't do well in its past track record at all, doesn't seem to be the best value, and doesn't seem to have the best balance sheet. So if I was looking for like a high growth stock, it seems like Snapchat might be that opportunity if that's what I wanted to look for. Similar sort of situation with Match Group. It has very good future prospects, okay track record, poor balance sheet, and doesn't seem to be good value either. So similar sort of growth story. And as for Twitter, it's got a pretty good balance, or like a good balance sheet, pretty good future prospects, but doesn't seem to have a good track record at all, and doesn't seem to be the best value. So having a look at that, I'm like, okay, well, I'm still going to research Facebook or Meta Platforms right now, but as part of my research process, I would go and have a look at these companies as well, just to get an idea of how they're performing in their respective reports. Now, the next section I have a look at is the price history and performance. And so this is where I gain some of the insights on the more qualitative aspects of the business and also in the recent news and updates here. And I'll share that in just a second. So as you know, we don't encourage you using share price movement as an indicator of whether you should buy or sell. But this particular section here is really useful for gaining insights on the underlying business and how it's been developing. So if you want to have a look at actually what's going on, you could go and have a look at these developments here, and they can help give you context and help you build your narrative around and your thesis around the stock, because it's so important to understand the underlying business, right? Like, stock investing isn't just about looking at the share price and buying and selling based on movements. That's speculating, and we don't encourage that at all. We want to be long-term investors here. So that's why we encourage getting to know the underlying business, and that's what you can do here. So any of these particular updates, you can have a read through these and see what's happening in the underlying business, and you can also see how the share price has reacted to these different announcements or pieces of news. And so nothing too drastic here over the past year, but after this video, for example, I would go through and read these updates and help build my narrative around the stock and understand more of the underlying business. And it's a similar story here in the recent news and updates. There's articles we have here from our partnership with Seeking Alpha, and these are written by their personal investors, and they have their own thesis, and they have their own narrative that they've built around the stock based on their research. And one thing to keep in mind is obviously that these are opinions, but they're still very useful to read, right? Because as I've mentioned in previous videos, you may have a narrative around the stock where you've read a few particular data points and you're like, yep, I'm very bullish on this stock. This section here is very useful to read because sometimes you can find articles and news pieces from other investors that show a contrary opinion as to why they're not very bullish on the stock or why they think the stock actually won't do well. And to help make a more informed decision, it can be very useful to read those articles because it gives you a new perspective that you didn't previously understand. So it's very good to read the articles in here, and that is what I would do after this video, have a read through these and just see what I found out. But that reading some of these and some of the news around the stock is how I found out those more qualitative aspects of what's been going on with the business. And this section here is also very good just to from the updates that Simply Wall Street provides, just to see what's happening with like earnings reports, insider transactions, executives leaving, or chief legal officers notifying of their intention to sell stock, these kind of updates. And again, all of these updates just help build the narrative that you have, or that you are trying to build, and your thesis you're trying to build around the stock. So that's what that section there is very useful for. Now, I also just look at this, or the next step I look at is this shareholder returns section, and I basically just try and compare how the company has performed versus the industry that it's in versus the market that it's in. So I typically only really care about this 1 year performance. 7 days too short for me. I'm not really too concerned about that section, but the 1 year performance, we can see that Facebook's gained about 24%, so a pretty solid year. But compared to the industry that it's in, the interactive media and services space, it's actually underperformed quite a lot. So there's been stocks out there that have performed quite better, and we saw in our previous video on Google that Google was one of them, right? Like, it gained like 67% of the past year, and so it's definitely one of the contributors to why the industry has performed so well. And compared to the US market, though, Facebook did outperform just by a couple of percentage points, so that's good to see. And this is over the trailing 12 months, by the way. So the next section I have a look at is about the company, and if I wasn't too familiar with the business, I would just read through here to see what the company actually does and like what its experience is and where it's come from and what it's doing right now. But in this case, I'm pretty familiar with the stock and the business, the underlying business, so I won't read through that. But if you weren't, I would definitely recommend reading through that. And so that brings us to the next section. So what I have a look at here is the fundamental summary of the business. And this bit's really useful because it takes us through some of the really core metrics of understanding how the business makes, not how it makes money, but how much money it makes and how much it has to spend to make that money and how much is left at the end of the day. So this first bit here just shows us the market cap being $936 billion, and the company has revenue of about $112 billion and earnings of about $40 billion. So with those numbers there, that gives us a price to earnings ratio of about 23 times. And you know, like I've mentioned in previous videos, you don't want to look at a PE ratio just by itself, right? To have some additional context of whether that PE ratio right there might be good value or, you know, overvalued, you need to understand what the company's expected earnings growth is. And we already know it's like just about 12%, so that can give us a bit of context. But looking at a PE ratio by itself can be very detrimental because you don't have any context around how that number is got. It's like PE ratios are very useful for like understanding the sentiment around a stock and how much investors are willing to pay for the future earnings of the stock. So it seems here like, oh, investors are willing to pay 23 times earnings, and it's expected to grow earnings at like 12%. So it seems like a a good opportunity where it's like good earnings growth but a relatively cheap price for it. Say for example it was like 50 times earnings or 60 times earnings with the same amount of earnings growth as like 12%. That wouldn't be as good of an opportunity, right? Because you're paying quite a high premium for not much earnings growth. Whereas in this case, it seems like a good balance of the multiple you're paying. And we'll get more into that in the valuation section. And as for the price to sales ratio, it's about 8.3 times. And given the company is profitable, this ratio isn't too meaningful to me because it's typically best used for like unprofitable companies. So I can already use the price to earnings ratio here, so that one isn't too meaningful. Now, the next section we have here is the earnings and revenue breakdown. And the insight here was quite interesting. So the company generates, as we know, $112 billion in revenue. And in order to generate that revenue, it only has to spend $21 billion. So that's an incredibly high margin business, right? Like that gives it gross margins of like 81%, which is really good. And to understand what, as we know, the revenue here is like the ad spend, right? Because Facebook makes money when people pay for ads, because they sell ads on their platform. And to understand what the actual cost of that revenue is, it's worth looking into the company's annual reports. So I've got this here. This is the latest annual report from 2020. It's 2021, sorry. No, 2020. And as a breakdown of how the company actually incurs its cost of revenue, we can see that here, right? So the cost of revenue expenses are primarily related to the delivery and distribution of its products. These include expenses related to the operation of our data centers and technical infrastructure, such as facility and server equipment, depreciation, salaries, benefits, and share-based compensation for employees in our operations team, and energy and bandwidth costs. So that's really useful to know, right? Because now we know that it's like, okay, Facebook's cost of revenue is related to its operations team, its data centers, and its technical infrastructure. So that's and as we saw, it only has to spend like $21 billion on that in order to generate $112 billion in revenue. So that's a very high gross margin business. And I'll get into this next step in just a second. So that leaves it with a gross profit of $90 billion, which is very solid. And now its expenses are $50 billion. And so to know what it's spending this money on, again, we can go back here to the annual report and see how it breaks down. Now, this particular page doesn't break it down. There's a page later on that does. But the expenses there are the operating expenses. And that is stuff like research and development, marketing and sales, and general and admin costs. Now, obviously, these are quite self-explanatory. This is like its investment in research and development. So any cost it incurs for people who are in the teams related to its like engineering and technical teams who are related to like building new products. Marketing and sales is obviously any advertising it does itself and how much it spends on that. And the general and admin is basically any expenses related to paying like employees' wages and stuff in the like the legal, finance team, human resources and teams like that. So that those teams there total $50 billion worth of expenses. And so once it's spent all that money on those particular areas, research and development, sales and marketing stuff, it is left with $40 billion in earnings over the past 12 months. And so that number there gives it a net profit margin of 35%. Now that is a very solid net profit margin, right? Like most companies are very envious of that and would love a net profit margin that high. Facebook has a very high margin business. Doesn't need to spend much money to make a lot of money, and so that's what gives it this net profit margin here. So interesting to know how the company goes from like the sales it generates all the way through down to its bottom line. That's the breakdown there. And so the debt to equity ratio is the last takeaway here, and it's 0. So Facebook doesn't utilize any debt, which helps us understand why it has like a perfect 6 out of 6 health score according to Simply Wall Street's analysis. So the next section I'll have a look at is the valuation section. And as we saw in the start from the snowflake, it scores it passes 3 out of the 6 metrics that Simply Wall Street checks. Now, this section here tells us that it's about 31% undervalued based on Simply Wall Street's estimate of fair value. And this is obviously in this visual representation here. So having a look at this, I might go, oh, wow, like, Simply Wall Street believes that the stock is undervalued. Now, one thing to keep in mind is this obviously is not a buy or sell recommendation. It's simply an indication of what the potential value could be based on certain inputs and assumptions. Now, if you wanted to have a look at the actual inputs and assumptions into this model, you can have a look at View Data just there on the right and click here, and you'll get to see all the inputs that went into this particular calculation and where the sources were for these particular estimates and how the company got to that number. Now, one thing to keep in mind as well is that this model you just saw is based on analyst estimates for the free cash flows for the next couple of years, and then the future cash flows that aren't covered by analysts are extrapolated out by Simply Wall Street based on a line of best fit. And so as analysts change their forecasts and change their estimates of fair value, this estimate here, right, right, we can see here, will change as well. So if estimates from analysts all of a sudden become way more bullish and they expect way more free cash flows, this fair value would change, right? And conversely, if it's reduced heaps, it would change as well. So I believe recently the fair value estimate was a bit higher recently before the news of the metaverse change came out, because analysts were quite optimistic on the company's earnings growth. But as the news came out and the analysts got to digest it, and they're like, oh, okay, this is going to be quite an expensive transition. There might be some lawsuits coming up as well about the company's like antitrust issues and stuff. The fair value, the estimates of future cash flows were reduced, and so that subsequently reduced the company's our estimate of fair value, because analysts expected less free cash flow growth in the future. So that's one thing to keep in mind. This chart here is dynamic, keeps changing based on analysts' forecasts, and also it's important to know the assumptions and inputs that go into it. So not a buy or sell recommendation again, but just a very useful insight to know what a potential valuation could be with those particular inputs. Now, the price to earnings ratio, this is interesting because, like I said, it's typically been pretty subdued because investors haven't been willing to pay too much for the stock based on the concerns and investor sentiment around the business. And as we can see here, it's actually trading cheaper than its industry, right? So 23 times earnings versus the industry being 28 times earnings. So it's cheaper than the industry, but we're going to learn in the future growth section if that's justified or not, right? So I want to see the earnings growth of Facebook or Meta platforms versus the industry's expected earnings growth. Now, compared to the market, though, Facebook or Meta platforms, you're gonna have to forgive me, I keep interchanging, isn't apparently as good a value, right? So the US market is trading at a multiple of earnings at about 17 times, whereas Meta platforms is about 23 times earnings. So we're going to get more context on that when we check out the future growth section and see what their expected earnings growth is, being the industry and the market. So next is the price to earnings growth ratio. That's not too meaningful to me here, so I'm not going to have a look at that. Price to book, not too meaningful to me. I'm not going to have a look at that. And so that brings us to the future growth section. Now, as we saw at the top, the company is expected to have earnings growth of like just under 12% per year for the next couple of years. And considering it had quite high earnings growth over these couple of years, it really has been subdued quite a bit. And as you can see, revenue is expected to continue growing quite steadily as it has been, but the earnings growth is much more subdued. And now, the reason why that seems to have come out is because of like I mentioned, the analysts have re-rated their estimates downwards because they believe that the expenses are likely to increase based on what the company has to do over the following years. So the transition to being a metaverse company will be very expensive, or more expensive than their current business is right now. So lots of reinvestment, and the potential maybe they're also trying to account for potential legal fines that the company might have to pay. So that might just be part of their models as well. So this section here is really useful just to see if there's like a change in the trend. And so we can see here, this is past performance. And so typically it's been trending up and to the right, and there has been a lot of earnings growth over the past like 12 months or so. So like we saw, it was 59% earnings growth over the past 12 months from late 2020 to late 2021. But the trend seems to be similar for revenue growth, but not the same for earnings growth. So one thing to keep in mind. Now, this analyst forecast of earnings growth and revenue growth is what I was talking about to give us some more context to the PE ratios we saw above. So Facebook is trading, it's interesting, right? Because Facebook is trading cheaper than the industry, right? The industry was 28 times earnings on a PE ratio of 28, yet the company is, the industry is expected to have earnings growth of 15 times, right? 15%. Whereas the company is trading at a PE multiple of like 23 times earnings, and it's expected to have earnings growth of about 12%. So that makes sense, right? The company is trading at this multiple because it's expected to have less earnings growth than the industry, and the industry is trading at this multiple because it's expected to have more earnings growth, right? So investors are willing to pay more to have higher earnings growth. So if I was looking at that and I go, I want to find a company that has high earnings growth expectations, I should actually probably go to the interactive media and services industry on the screener, and then try and filter for stocks that have earnings growth expectations like above 14% or something, and that would filter out Facebook and show me other opportunities that might be higher earnings growth, if that's what I was looking for. And now, as we saw with the market, it's trading at a multiple of about 17 times earnings, and it's expected to have earnings growth about 13 times. So this is quite interesting, right? It's trading at a lower multiple than Facebook, but it's expected to have higher earnings growth than Facebook. So that's interesting, right? What we could do here is the same thing, right? Go to the screener, filter for the US market, and filter for companies that have earnings growth expectations higher than like 13%. And we could find potentially better opportunities where they're trading at a lower multiple and have higher earnings growth, because that may be a better opportunity than what we're looking at here with Meta platforms. So That's just one takeaway to keep in mind there. And it's a similar sort of story with the revenue growth. However, the revenue growth for the market isn't as high. So nowhere near as high. It's up about 9.5% versus 14% for the company. So it doesn't seem to be as high sales growth, but the revenue of the industry and the company seem to be pretty much on par. So that's good to see. Now, as we saw, those are the checks that we're doing there. It's not a super high growth, a high earnings growth company, but it used to be, like back when it was earning 20 to 30% per year, but it's not expected to do so anymore in the future. And the same thing there, it's a bit slower than the market, and those are the other checks that we talked about. So it's not super high growth. Now, this section here is quite interesting, right? So the earnings per share growth forecast is basically a useful chart here to show us what previous expectations have been and what the expectations are going forward. So we can see the blue line here is the earnings per share for the trailing 12 months that have been recorded like previously, and the blue shaded area is the actual range of analyst estimates over that time. And now going forward from here, the teal blue line is the average of analyst estimates for EPS going forward, and the teal shaded area is the range of analyst estimates going forward. So the most optimistic analyst forecasts are the top line, and the least optimistic or the most pessimistic are the bottom line. So you can see some analysts here expect earnings growth to just continue, whereas some analysts actually expect earnings per share to decline over the next year or two actually, and then to recover in 2024. So that's quite interesting. Now, what you can use this chart for, or what I use it for, is I go and have a look at the qualitative aspects of the business, like I mentioned, like what they're trying to work on in terms of like the metaverse and like how that might contribute to their bottom line, and like what their business model there will be, probably very similar to the existing one. And once I've done more qualitative research on the business and read all those articles and read more news about it, I try and make my own decision of like, okay, what do I think these projects and initiatives that they're working on, how much do I think they will contribute to the bottom line? Like, will they be very profitable initiatives, or will they not be very profitable? And that will help me make my own estimate of where I think earnings per share could be in a couple of years. So like I've mentioned in previous videos, if I think the initiatives they're working on will be much more profitable than everyone's expecting, my estimate may be up here, right? And I may say, I reckon earnings per share will be $22 by the end of the year 2024. And if that's the case, that means I reckon earnings growth will be much higher than analysts expect right now, right? So that means that I might look at the share price today and be like, oh wow, I think it's even more undervalued. Oh, I think it's undervalued compared to what I'm paying right now. Alternatively, let's say I look at those same developments and I'm like, the metaverse and like the social media platforms and everything they're working on, I don't think their earnings growth is going to be that good. Let's say I expect the earnings per share to be like $16 or even less by the end of 2024. If that was the case, that means I would believe A, the earnings growth is going to be much less than everyone expects, than the consensus expects, and B, that means I might think today's price is a bit overvalued because I'm paying like, let's say, a higher multiple for not as much earnings growth. So that's one thing to keep in mind. Like I might be paying 23 times earnings right now, but my expectation of the earnings growth might be like 5% per year or something like that. So that's what I use this section for, and it's really useful to come back to once you've done some more qualitative research on the stock. And so the future return on equity just shows us how profitably the company is expected to allocate shareholders' equity in the future. And that's a really good sign to see that it's expected to be about 26% in the future. And compared to the industry of 13%, similar to Google actually, which we covered the other day, it's much, much better. So good to see that this company is expected to, from analysts, have plenty of profitable reinvestment opportunities within its business. So that's good to see, especially since it doesn't utilize debt, right? Because debt can sway this figure a bit. If the company was to utilize heaps of debt in its capital structure, this could actually make the return on equity look even higher. So that's just one thing to keep in mind. Now, the past performance, this company, as we saw, has smashed it out of the park. So Meta Platforms has generated 24% historical annual earnings growth, which is a very solid number. And as you compound that out over time, it's just insane. So it was earning about $2.7 billion back in 2015. And if we now look at it, it's generating $40 billion. So that's about 25% per year. Just a huge earnings growth. And that is so impressive to see. So had a bit of a decline here in 2019 and at the start of over 2019, but it's recovered significantly, so that's really good to see. One thing to keep in mind is the operating expenses. So as we can see, the profit margin back here was about 18%, and it's now about 35%. So one thing to keep in mind is that the operating expenses don't seem to have been increasing as much as revenue has, right? So we can see this purple line here is that expenses we were talking about above, being research and development, sales and marketing, and general and admin. And so as the company has reached scale and been generating more sales, it hasn't had to spend as much money to generate those sales, right? Because it's just got more business coming in. It's a very scalable business model. So, pardon me, its top line has been improving, but it hasn't had to spend as much to generate that top line growth. And so what that results in is an improving profit margin. So we can see here that profit margins were 32% last year, but they're now 35%. So they have been improving, and that's thanks to that revenue growth, which is really good to see. Now, as we saw, it may not be the case going forward because analysts seem to expect earnings growth to kind of slow down, given they think it might cost a bit more to run its business in the future or transition its business in the future. So more of the same here. Really impressive past earnings growth. It's much better than the industry that's in and much better than the market that it's in over the past 5 years. And the last year of earnings growth significantly surpasses the industry that's in, significantly surpasses the market that it's in, because it generated like 60% earnings growth over the past year, which is really impressive. So it passes all these checks, really good to see. And the company right now has a high return on equity. So currently, as it stands, it is allocating shareholders' equity very profitably because it's able to generate a return of like 30% on every dollar of shareholders' equity that it invests, which is really good to see. And like we said, it passes the industry average, so that's really good. It's also got great metrics on the return on assets and return on capital employed. So return on capital employed, even though it doesn't actually utilize any debt, its return on capital employed is about 30.9%. So that's really good to see. And the return on assets as well is 23.5%. So it surpasses the industry by a wide margin, which is really good to see. Like you can see, it's even literally could be off the charts because typically, from this, we can see that Facebook is a very asset light business, right? Like it doesn't need a lot of assets to run its business. It's quite digital. It doesn't have any serious amounts that it needs to invest in like infrastructure and stuff. So it's got a huge return on its assets. As for the capital employed, this is basically like its total assets minus its current liabilities, basically the the capital that it has employed in the business. And we can see that it's slightly improved over what it was 3 years ago, right? So it was 28%, now it's almost 31%. It's good to see that it's moving in the right direction. Now, the next section we have a look at, or I would have a look at, is the financial health section, just to see if the company is utilizing any debt. And in this particular situation, it's not, right? So it doesn't have any debt on its balance sheet. I believe it doesn't. No, yeah, still zero. So that's really good to see. One check I would just stress that I would do here is to see, and we actually check here on the report, is if its short-term assets cover its short-term liabilities, and if its short-term assets cover its long-term liabilities. Now, why do we check both? Well, first of all, this is liabilities, anything that's going to be due for the company that has to pay within 12 months. So it's stuff like accounts payable, rent, for example, and stuff like that. And so it's good to know that the company has enough cash and cash equivalents on hand to pay any of those liabilities should they come due in the future. And now we make the same check of if the company can pay its long-term liabilities with its short-term assets, and that's because you wouldn't want to try and pay your long-term liabilities, which is anything that needs to be paid that's expected to be paid within past 12 months, because why would you want to pay it off with long-term assets, right? Like if you've got long-term assets, these are typically illiquid assets, so it's like properties, anything that can't really be liquidated quite quickly. And so people might ask, why shouldn't we check this against that? But it's like, no, you wouldn't want to try and pay like something that's due over 12 months. Like you wouldn't want to pay with it by selling a property, for example. You want to pay it off with cash. So that's why we do that check here, and we can see that it easily surpasses all of them. So that's really good to see. Now, the debt to equity history analysis isn't too meaningful, but it's basically encouraging to see that the company has chosen to never utilize debt. So it's got a very solid balance sheet, very safe, but its cash has continued to grow and its equity has continued to grow as its retained earnings have continued to grow and the share price has appreciated, and the cash has continued to grow as it's just like continually like grown its earnings. Its cash balance has just improved because it's like it's reinvesting in itself and it's now doing a buyback program, but its cash, just like the leftover cash that it has just grown hugely from $12 billion to $58 billion. So very, very safe business there in that respect. So no huge need to go into the balance sheet here because it's a very safe business that doesn't really utilize debt. Obviously, you can look at it if you like, but in this instance, I'm not going to. And now as for the dividend, the company doesn't pay a dividend, as we mentioned at the start. However, it does have a buyback program, and like I said, it's bought back about $23 billion worth of stock, and it's expected to buy back another $50 billion. It announced that in its earnings result in like October. And so if that comes true and it ends up buying $73 billion worth, that would result in about 7.8% or so of the company being bought back, given its market cap of like $936 billion. which basically means that there would be less slices in the pie. Like I mentioned at the start, there would be less shares outstanding for the remaining shareholders, right? So effectively, if you're a shareholder and the company is buying back stock from other people that aren't you, and you're not selling your stock, you effectively now own a bigger share of the profits, right? And so the earnings per share figure would go up because there's less shares outstanding. So yeah, you as a shareholder would have a bigger slice of the pie, and that's one way that companies can return capital to shareholders, by actually just reducing the amount of slices in the pie. So your slice would get bigger. So that's quite common in the US. They typically do that because they don't have they get taxed twice on dividends. So that's one thing to keep in mind, because the company gets taxed at the earnings of the company level, and then you get taxed at the individual level. So it's quite not the best way sometimes to return capital to shareholders, but it's some companies still utilize it. And now the very last section here is the management section. So as I mentioned at the start, the company has like a good tenure for its management team, about 6.3 years. So they're pretty experienced and they've been there for quite a while. But the board doesn't seem to be as much, right? So before we get to that though, we'll just have a look at the CEO, which is Mark Zuckerberg, and he's been there since day dot, being the founder and everything. So let's have a look at his compensation and see how it compares. So his compensation is actually apparently above what companies of typical similar sizes in the US market are. So they typically pay around $11 million, and his compensation recently has been $25 million. So it's above average, which can be a bit concerning. However, if we look at this, we can see that Mark's compensation has actually been consistent with the company performance over the past year. So what we can see here is that he doesn't, I don't believe... receives a salary of $1, but this blue line here is his total compensation. And what I'm looking for is I want to see that it follows in line with this yellow dotted line, which is the company's underlying earnings. And it's good to see that it literally has been following the trend. As the company earnings have improved, so has his compensation. So he's being compensated in alignment with company performance, and as a shareholder, that would be good to see. Well, that is good to see. Now, the next section I'd have a look at here is the leadership team. And like I mentioned, we can see that their tenure is quite experienced, right? Like they've got years of experience. There's only a few new people in the management team or the leadership team, but the average tenure is 6.3 years. So good to see. And now in regards to ownership, they do own a fair bit of stock for those that we have data for. So this is holdings in their individual name. And we can see here that Mark owns plenty, $11 million, $478 million, $362 million, $92 million, $374,000, 4.4, and then there's no data for these people here, unfortunately. So that's good alignment for those that have data, and it would be encouraging to see if there's any if there's more purchases that are done in the future to increase alignment with shareholders. But for the most part, it's good to see that those that we do have data for have like tens or hundreds of millions of dollars or billions of dollars invested in the stock. So that's good to see. Now, the next section I mentioned was the board members. And like I said at the start, their average tenure is actually 2.7 years. And that's because there isn't as many experienced players in the board. So there is plenty who are, being these couple of players here. But there's many new members in the board that actually haven't been there too long, like less than 2 years. And so their investment in the stock doesn't seem to be as high as what we saw in the leadership team. So from an investor's point of view, you might want to see actually more ownership of the stock from the board members here. So there's plenty from these who are long-term investors. However, these board members here don't have as much invested. So this is investments in their own personal name, because it's very difficult to track investments in like entities. So they may have entities that own shares in like a company or a trust account, but just in their own personal name, that it isn't huge amounts invested given the size of the company. So just something to keep in mind. Now, the last section to check out is part of management, I suppose, but it's ownership. So we want to see if there's any insider selling or buying that's been occurring. And the main takeaway I want to find here is if there's been large amounts of insiders selling large amounts of stock, or if there's been large amounts of insiders buying large amounts of stock. Now, those would give me some like trends, right? Like it'd be like, oh, okay, why is there such a large amount of insiders selling their stock? Like that would be a negative signal, and I'd be like, okay, there's something I need to look into, because they clearly are like offloading a lot of stock. Why is that? And conversely, on the other side, if there's a whole bunch of insiders buying stock, I'd be like, that's quite an optimistic signal. And I'd be like, okay, why are a whole bunch of insiders buying lots of stock? And I want to look into like if there's any sort of upcoming catalyst coming up that might be a reason to own the stock. So as we can see here, though, there's just been a trend of selling, and this looks quite concerning, right? Like $33 million, $144 million, $100 million, $59 million, and this is all sold over the past year. And as we look at it, so it's like, yes, insiders have been selling, and then let's have a look at the recent insider transaction details. And as you can see here, the vast majority of the sales, other than a couple of insider individual sales is from the Chan Zuckerberg Foundation. And so it's I'm not too familiar with it, but I believe this would just be sales of stock to fund the operations and the charitable donations from that particular foundation. So that's typically how they work, but that's something I would need to look into further. Not too concerning though, given I can see it's got foundation in the name. So it's not like we saw an individual insider like offloading their whole position. It's just basically a trimming, consistent sales of stock from this particular foundation, so it's typically fine. Now this ownership breakdown just shows us that institutions own around 2/3 of the stock, and that makes sense because it's such a big company. It's like a lot of institutions would own it through, like we'll see in a second, the Vanguard Group, BlackRock Group, these kind of big institutions, they own shares because they have these big ETF products and managed funds and stuff, so they invest into the largest companies like in the S&P 500 and stuff, so it makes sense that they're a big owner. The general public owns around 17% of the stock, and individual insiders own around 15%, being Zuckerberg and the like that we saw. So shareholders haven't been diluted, which is great to see. They've actually been the opposite, where they've had their slice of the pie increase, and it's likely that will continue to happen in the future as that $50 billion buyback program continues. Or starts, I should say. And now this top shareholder section here, I would just use this to have a look and see if there's any large change in any particular shareholder's holding. So looking at this column here, the change, the amount of shares bought or sold in the last 2 reporting periods, we can see that there's no real noticeable huge trades, right? Like they're all a couple of percentage points, nothing too major, right? Like what I would keep an eye out for is exactly the same as I saw above. I want to see if there's large amounts of these large shareholders selling stock and like selling large amounts of stock, or conversely buying stock, because it would be, again, optimistic signals if they're buying, pessimistic signals if they're selling. But in this case, there doesn't need to be any strong signals, so not too meaningful to me here. So that's the full overview of running through Facebook and the company report on Simply Wall Street. And like I mentioned, we found those insights of like through reading those news updates, it's like the company's had like a challenging couple of years, and it's likely to be challenging in the future. The earnings growth expectations are a bit subdued, given the fact that it's like only 12% compared to the previous years when it was like 20 or 30% earnings growth. And that's probably because analysts believe that the the expenses will increase as it tries to fund its transition into being a metaverse company. So the company is potentially undervalued based on Simply Wall Street's estimate of fair value. And so to get more context on that, what I would go do next is try and research the metaverse space and like see how Facebook actually, try and get more understanding of how Facebook wants to monetize that particular business model. And then I can go back and try and do my own valuation, like an Excel spreadsheet, and do like a discounted cash flow and just slightly tweak those numbers and based on my research, right? So go and do all the research, try and get some context and help build my narrative and thesis. And then when I go and try and do a valuation, I get more context about what numbers I should input into the model. So yeah, that would be my next steps, reading more about the metaverse and how it plans to transition. I read more a bit about the antitrust issues and concerns about that sort of area of its business and see how Facebook is trying to address it. Like I said, a couple of $1 billion invested over this year. So that'll be promising to see. But yeah, that would be my next steps, and I'll add it to my watch list actually, so I can stay up to date on the stock and just get notified from Simply Wall Street about like earnings reports, insider transactions where they sell, executive departures and stuff like that. So yeah, that's pretty much all for this video. I hope it's been helpful. If you have any questions, please let us know in the comments below, and we'll try and get back to you as quick as we can. But yeah, other than that, thank you so much for watching. I'll see you next time.